In a world more connected than ever, money no longer stays within borders. Investors from big institutions to university students are looking outwards, discovering new opportunities across continents. This is the story of international investment and why going global may shape the future well. Have you ever wondered why the smartest investors never keep all their money in just one country? Because growth isn't equal everywhere. While most developed markets rise only 1 to 3% a year, countries like India grow above 7%, Vietnam close to 8%, and Indonesia around 5 to 6%. And global investors get to own that growth. Look at where the world's opportunities actually are. Taiwan Semiconductor Manufacturing Company, TSMC, producing 90% of advanced chips that power AI and iPhones. India, now the third largest stock market, home to giants like Reliance, Infosys, and HDFC Bank. Indonesia, a powerhouse in nickel and copper, the metals behind electric vehicle batteries. These are not risky bets, they are the engines of tomorrow's economy. And here's something most investors forget. When your home currency weakens, a strong rupee, dong, or rupiah can actually boost your returns. Plus, when one region slows down, another region speeds up. That's real diversification at work. Keeping everything in just your home country isn't safe anymore. It's actually one of the biggest risks many investors never see coming. We have seen the reason to go global, which are growth, diversification, and new opportunities. But how do investors access these markets in practice?
There are several methods that investors commonly use, and the first one is foreign portfolio investment. This simply means buying financial assets from another country, such as foreign stocks, bonds, ETFs, or mutual funds. This method is popular because it's easier, more accessible, and doesn't require you to manage a business overseas. Many investors use online trading platforms to buy US, European, or Asian stocks directly. The second way is through foreign direct investment, or known as FDI. This involves investing to gain some level of control in a foreign company. Examples include opening a branch or subsidiary overseas, forming joint ventures with foreign firms, or acquiring an existing company. FDI is usually long-term and gives investors more influence, but also comes with higher risk and commitment. Another option is investing in international real estate. This can be residential or commercial properties in another country. Investors usually do this to enjoy rental income, capital appreciation, or to diversify across different markets. Finally, there are also global funds and international ETFs. These funds allow investors to get exposure to many countries at once without choosing individual stocks. It's one of the simplest ways for beginners to start investing abroad because the fund manager handles the selection and management. We have seen the various ways to invest internationally. Investors can invest abroad through portfolio investment, direct investment, real estate, or global funds. Each method comes with different levels of risk, control, and accessibility. So those are the ways you can invest overseas. But of course, nothing comes risk-free. Let's look at the risks and how investors can actually manage them.
So yes, investors have many ways to go global, but once we step outside our own borders, the game changes. International markets offer huge opportunity, but they also introduce risks that every smart investor must understand and manage. Okay, first, political and economic instability. A new government, a sudden ban on export, or a change in tax can turn profit into losses overnight. That's why a professional investor don't rely on just one country. They study political stability, they do some research and spread investment across multiple regions, so even if one market struggles, the rest can balance it out. Next is exchange rate risk. When investing abroad, returns don't depend only on company performance, but they also depend on currency strength. A strong investment can lose value if the foreign currency weakens. To manage this, global investors use currency hedging and invest in multiple currencies to ensuring their returns don't depend on only one currency movement. Furthermore, is information and regulatory barriers. Different laws, business culture, and accounting system can create confusion and mistakes. If you invest in local company, it's easier for you to gather the information, but if you invest in foreign company, it must be difficult to have information about their condition and situation. This is why to cater all of this, investor must work with trusted global platform, research analysis, and local experts who understand the rules on the ground. Another challenge is delayed reaction time. Because of time zone difference, language barrier, and late information updates, investors may react slower to news happening in another country and miss the best moment to buy or sell. Not all markets open and close at the same time. For example, when the US stock market is open, market in Asia is already closed, and vice versa. So if important news happen in another country after we are asleep or after our market close, investor might react too late, missing the chance to buy at a good price or sell before a market drop. To manage this, professional investors use real-time global monitoring tools and set automatic alerts or stop loss orders to respond instantly. Lastly, market volatility. Fast-growing economies can also fall faster than developed markets. So instead of going all in on one country, smart investors build a balanced global portfolio by mixing fast growth markets with stable ones.
Managing risk is only half the journey. The other half is knowing where to invest. From Asia to Europe to emerging markets, each region offers different opportunities and challenges. North America is the most developed and liquid market, known for its strong sectors such as technology, healthcare, and finance. It offers high transparency, strong regulation, and stable, consistent returns, though its stocks often come with higher valuations. Europe is also a developed market, but generally experiences slower economic growth compared to the US. Its strength lies in manufacturing, energy, and luxury goods, but political events like Brexit and energy-related issues can influence performance, resulting in stable yet moderate return. The Asia-Pacific region, which includes China, Japan, India, Korea, and Southeast Asia, is one of the fastest-growing markets. It is strong in technology, manufacturing, and consumer sectors, offering high potential but also higher volatility due to political uncertainty, currency fluctuations, and varying regulation. Emerging markets such as those in Latin America, Africa, the Middle East, and parts of Asia provide the highest growth potential as their economy continues developing. However, they come with significant risks, including political instability, weaker regulatory environments, and currency challenges, making them attractive mainly to investors seeking the higher long-term returns. To conclude, North America is known for being stable and innovative, while Europe is steady but grows at a slower pace. The Asia-Pacific region is fast-growing and dynamic, offering strong opportunities, and emerging markets provide for higher potential but also come with a higher risk. By understanding those regional differences, investors can make a better decision and build a balanced, diversified portfolio.
When it comes to international investment, success is not just about returns, it's about comparison. That's where benchmarking comes in. Benchmarking is the process of measuring investment performance against a standard, like an index or peer group. For global investors, this could mean comparing a portfolio returns to the MSCI World Index or regional indices like FTSE Europe or S&P Aisya 50. But benchmarking internationally is not simple. Why? Because global markets are diverse, currency fluctuation, political risk, regulatory differences, and varying accounting standards all complicate the picture. Take developed versus emerging markets. Developed markets offer stability but lower growth, and emerging markets higher growth potential but with greater volatility. Comparing investment across this region requires more than just looking at returns. You need to adjust for risk, inflation, and currency exposure. What about real-world challenge? There is plenty. Think of 2022 energy crisis, US-China trade tension, or Brexit. This event reshaped investment landscape overnight, making historical benchmark less reliable. So how should investors respond? By benchmarking smarter. That means adjusting for risk, currency exposure, and inflation, and also understanding what's driving performance, not just the numbers. In today's interconnected world, benchmarking is more than a scorecard. It's a lens for understanding risk, opportunity, and strategy.
From New York to Tokyo, from London to Kuala Lumpur, the world of investment is bigger than ever. Investing internationally opens doors to innovation, growth, and resilience. For those willing to explore beyond borders, the future of finance is truly global.